Hello everyone, this is Terry with Futures IO, and as always I would like to thank you for joining us today. It is my pleasure to welcome back Richard Weissman and David Forss from DTN for today's webinar, Day Trading Oil Futures, Reducing Risk and Increasing Profits. Throughout the webinar, if you have a question, please feel free to type them into the questions box throughout the webinar. We'll do our best to answer them at the end of the event. This webinar will be recorded and posted on Futures.io website within 24 to 48 hours. If you're watching this afterwards on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. And as always, please feel free to share, comment, and subscribe to the channel. It really helps us a lot. For sharing news, events, and information, follow us on Facebook, YouTube, and Twitter using @FuturesIO. And now, without further delay, I'll hand it over to Dave. You'll get the pop-up to share your screen again. All right, Dave, it appears you're still muted. Dave, are you there? One second, folks. I see your screen, Dave, but it looks like you're self-muted on the platform. Richard, are you there?
I am here,
okay.
yeah.
Okay.
Okay.
You got it?
Yep, there we go.
I found it. I found it. Okay. We ready to go?
Yes, she's all yours.
Okay. Thanks a lot, Terry. Sorry about that. Yeah, this is Dave with DTN. Thank all of you for attending today's webinar, Day Trading Oil Futures, Reducing Risk and Increasing Profits Using Tools that Apply to Any Market. Will be presented in just a minute by Richard Weissman. But first, there we go. But first, we want to thank Big Mike and Futures.io and mention that Futures.io is the best futures trading community on the planet with over 100,000 members, many using our DTN IQFeed data. Futures.io members usually think of DTN as that company with the IQFeed data feeding real-time tick-by-tick price quotes into one of their charting and technical analysis software programs like NinjaTrader, Sierra Charts, MultiCharts, or one of about 80 other programs. But DTN is trusted by 2 million customers worldwide to deliver the best information, analytics, and news in our 4 major industries. The first of our 4 major industries is the agriculture, where for more than 30 years, DTN has been the most trusted provider of ag-related data. With the industry's most awarded agriculture newsroom, investments in proprietary tools and methods, we give producers what's needed to generate the greatest yields from every acre, every crop, and every head of cattle. The second industry in our 4 major industries is weather, where we've been independently rated #1 in forecasts for the last 10 consecutive years. We are also the only weather provider with on-demand online consultations with meteorologists 24/7. Our aviation weather division is deployed in over 250 airports worldwide. Our patented global flight hazard forecasts, including best-in-class predictions of turbulence and icing, ensure safety for over 50 airlines. The third industry of our 4 major industries is energy. We deliver information in real time to more than 1,900 terminals in the US and Canada, where we manage 80% of the supply chain pricing and billing transactions every day. We've been the preferred supply chain vendor for more than 25 years and have the solutions, the expertise that help buyers, sellers, and shippers make better decisions and operate more efficiently. Financial analytics is our fourth industry. The IQFeed data service is a product of our active trader division. Richard Weissman, who you'll be hearing from soon, is a trainer in the education and consulting division. His training schedule can be found on the DTN.com website. Also, from the DTN.com website, you can sign up for a free trial of the IQFeed data service. As a Futures.io member, you qualify for the half-price special. The above link takes you directly to the IQFeed free trial sign-up site specifically for Futures.io members. But as I mentioned, you could also sign up from the DTN.com website, where there is a free trial link. While signing up, the system will ask you how you heard about IQFeed. Be sure to select Futures.io. This will qualify you for that half-price special. Then after the free trial period, contact me, Dave Forss, if you would like to subscribe. My contact information and that free trial link will be available again during the question and answer session. But at this time, I'd like to introduce Richard Weissman from the Education and Consulting Division of the DTN Financial Analytics Industry. Richard?
Thanks so much, Dave. I appreciate working with you again. So everyone should be able to see my screen now. Let me get the presentation up for everyone. So what I wanted to do today was actually a request from the IQ attendees from the last time we did a webinar together, and that was day trading. So I wanted to take this time and look at day trading oil futures, how we can reduce risk, increase profits, and these tools that I'm going to introduce, I'm going to showcase in oil, but they are applicable to any asset. So we're going to use the ProfitX software, and we're going to highlight how we can day trade using a wide array of tools. Those tools include the Chicago pivots, average true range. Now, why is average true range important? Because it can give us a mathematically objective answer to the question that all day traders need to answer, which is, where do we place our stops? How much unrealized profit is sufficient in order for us to use stop, in order for us to move our stops, and when to take partial profits. I'll also show you a rule-based approach to market profile. One of the big complaints about market profile in day trading is that it's subjective. So I am going to give you just an example, a couple of examples of a rule-based approach to market profile. Then I'm going to show how I day trade, including what type of tools I use in order to determine what type of trading day we're expecting. Is it going to be a trending day or a choppy trade or a choppy day? And finally, one of the main things that I found useful over my years of trading, especially when day trading, is how you use the clock itself as a risk management tool. Okay, so first things first, what is successful day trading? Successful day trading is the casino paradigm. And the casino paradigm is simple. It's simple to understand. It's not rocket science, but it's not necessarily easy to implement. And that's what I'm going to try and help us with today, is how we can take these simple tools and make them a little bit easier to implement. So what is the casino paradigm? It is a positive expectancy model. What does that mean? It means that even after deducting for the cost of the transactions, commissions, and the spread between the bid and the ask, it still makes money. Also, that positive expectancy model needs to be combined with prudent rules of risk management. And the gold standard for speculative traders is what's known as the 1% rule. It was outlined in Schwager's Market Wizards in the Larry Hite interview. And the idea is very simple. If you have $100,000 in an account, you don't want to risk more than 1% or $1,000 on any given trade. And then finally, the third element is trader discipline. How do we stick with this positive expectancy model and continue managing the risk when losses come in clusters? So I'm not going to spend a lot of time on the casino paradigm. First of all, I covered it in great detail during prior webinar. Also, it's highlighted in my second book, which is called Trade Like a Casino. But just so we're on the same page, this is what successful trading is, and it applies to day trading as well, which is where our focus is going to be. Give me just a second. I am, there we go, try that. There we go. So how do we trade the cyclical nature of volatility? So what is the cyclical nature of volatility? Volatility cycles from periods of high volatility to low volatility, high volatility to low volatility. So the tricky thing about being a day trader is when we are in low volatility, like before a report is released, before the inventory report is released in oil, or before the WASDs are released in the ag market, or before the employment report is released in financial markets, we have low volatility, and that represents the exact opposite of what we're looking for as a day trader, because it represents high risk. In other words, once that news event is released, we could end up in a runaway train going against us. So the best rule of thumb I've found for day traders is when you experience low volatility, especially when it's in front of a known report that's going to be released, you stand aside and you wait for a breakout from low volatility. And how do we trade high volatility? As a day trader, generally speaking, what you're going to want to do is fade the directional movement that accompanies the historically high vol reading. So that's how I do it. Okay, so let's go on and talk about some of the tools we use. So the first of these tools are known as pivots. Pivots are, the pivot is a widely used tool by short-term traders, day traders. It's calculated based on the high-low close of the range, and it helps us to identify support and resistance levels. And the key points of these support and resistance levels is that they are applicable to the coming trading day, short-term support and resistance levels. So the 5 points of the Chicago pivots, there's the Chicago pivots, the New York pivots. I use the Chicago pivots. They are the better known pivots. Those pivots are actually highlighted, and you can actually find them on the ProfitX feed. And you can see the calculations. I won't go over them. You can read them. This webinar will be available later on. You can pause the presentation, write down the inputs. But the idea is you've got these 5 points. The pivot, first level of resistance, second level of resistance, first level of support, second level of support. And based upon where we close, where we open, where we're trading before the release of a report, that gives you an idea of how you're going to play the pivots. And I'm going to show you this with a couple of recent historical examples as well. So here you can see the pivots, and basically the market on this slide is oscillating between the main pivot and support level 1. And the idea is, generally speaking, you'd probably try and buy into support level 1 and sell into the main pivot. But I'm going to show you a methodology that's a little more robust than that. I just want you to get an idea of what they look like and see how they act as support and resistance levels. Okay, next. Let's say that we make a decision, we want to buy into support level 1 on the pivots. Where do we put our stop? How much unrealized gain before we can move our stop to break even, and where do we take partial profits? So all of that is going to be a product of average true range. An average true range is a product of true range. So what is true range? Wells Wilder defined an asset's true range as the true high minus the true low, where the true high is the greater of the current bar's high or the close of the prior bar, true low, lesser of the current bar's low or the close of the prior bar. And by measuring the asset's true range, as opposed to measuring from the daily high or daily low, it accounts for the possibility of price gaps overnight, or price gaps from Friday's close to Sunday's open, and is therefore a more robust measure of the asset's volatility. And then we take the true range and we find the average true range, which is the moving average of the 10-period true range. You can calculate it differently, but that's one of the most common ways of calculating it. You could also calculate it as a 14-period. You can also calculate it as an exponentially weighted moving average. These are common ways of calculating. Okay, so here you can see an example of true range, and notice that we're measuring from the previous close to the low in order to get the true range. We're not measuring from the high to the low, right? So it gives us a more accurate measure of historical volatility. Okay, next, what is market profile? Market profile is a statistical approach to price analysis. And traditionally, each letter represents a new time interval, and traditionally these are set to half-hour intervals, and we use these letters to determine the value area. So that's going to be an area encompassing 70% of the price action. And then when we go above the value area or below the value area, that favors a return to the value area. So day traders tend to buy when you're below the value area, sell when you're above the value area, and to try and get out or take profits into the point of control, the middle of the range. Now, as you get away from the value area, the volume, all things being equal, will tend to dry up. And what that suggests, if the volume dries up as you get away from the value area, market profile traders call that the cave. And all things being equal, we want to see how many buyers, how many sellers will be interested in these price levels. And in days to come, we call that filling the cave. So these are key terms in market profile: the value area, the point of control. Some of these are self-explanatory, like high of the day, low of the day, the value area high, the value area low, the day before yesterday, and the initial balance in the market. So I'm going to now outline some methods for market profile. And the reason behind some of this stuff is people say, oh, well, market profile, that's like subjective technical analysis. You can't do anything with it. It's, you know, it's like a Rorschach test. So here I'm going to show you some objective rules for market profile. And again, I'm going to go over this briefly, but you'll be able to see it later on if you come back and view this webinar. So in a downtrending market, if the primary session open, so primary session is going to be different for every asset, but in crude oil, we're going to call the primary sessions open 9 a.m. Eastern time. So in a downtrending market, if the primary session open is below the value area low, then our rule tells us we're going to sell at the value area low, and we're going to put a stop 20% of the 10-bar average true range above the value area high. So that's objective. In an uptrending market, it's the same rule, just opposite. Okay, now what happens if the primary session opens within the value area? So in a downtrending market, if the primary session opens within the value area and 25% of the average true range is less than the value area high, then we'll place a limit order to sell at the value area high with a stop 20% of the 10-bar average true range above, greater than, the day before yesterday's point of control. And if we have an uptrending market where we have the primary session open within the value area, then it's going to be the exact opposite rules. So that's a rule-based approach to market profile. And here you can see some examples of market profile in crude oil. And you can see right here, you can see some clustering in the value area. And here you can see lots of clustering. And then we're actually, looks like in this one, we are creating a new range. And this will probably result in a new value area in days to come. So I just wanted you to see that, just so you get the idea of what it looks like. Okay, let's get into how we use pivots. How we use pivots in combination with average true range in order to enter the market, place a stop loss order, trail the stop, take profits. And this is a real day in trading. So let me show you what I did here. Okay, so first things first. Look at where we are on January 30th of this year, and we are trading prior to the release of the 10:30 Eastern Time inventory report. And basically what I'm seeing is prior to the report, we are unable to break the resistance at 54.17. And so my guess is that if we can break the resistance, right, the volatility expanding, right, we have narrow, low volatility prior to the release of the inventory report in crude oil. So my bet is if we can break to the upside, break that resistance, then I want to be a buyer. Psychologically, why is that the case? Because you have lots of weak day traders that have been selling into that resistance, into that low vol. Now, if we break resistance level 1, pivot R1, that's going to be a good buy for me because all those weak shorts are going to have to cover. Them covering is going to enable us to have profits. Okay, so let me outline how I'm going to trade this thing. So here's the resistance at pivot 1, the resistance 1, pivot resistance 1. So I'm going to place a buy stop limit at 54.17. Why not a buy stop? Because these reports, what if it's wildly bullish? I could end up buying $56 a barrel, something crazy like that. So I'm going to place a buy stop limit. If it fills and they fill me, I'm going to be long the market at 54.17. Okay. And of course, that's exactly what happens. And we know we get filled because we come right back down to it. Now, my target, guess what? Pivot R2, right there, 55.09 for 50%. Why 50%? Because what if this thing really takes off? Then I don't want to exit the entire position, but I want to take a piece off right there. And if we hit 55.09, I'll cancel my stop on the remainder to a break-even stop at 54.17. Now, how about my stop loss? My stop loss, there's lots of different ways of doing this. You can put a stop under this support here. You can do 2 times the average true range as your stop, 32 cents below entry. If you choose 32 cents below entry, that's your stop. 32 cents minus 54.17 with a profit target of 55.09. So that's how I trade the pivots and average true range as a day trader. Okay, what happens? So what happens is we fail to reach our target. So this is a phenomenon I call of, sorry about that. We fail to reach our target. So this is a phenomena that I call shoot for the stars, land on the moon. So my target was 55.09 for 50%. But as you can see, as the trading day wears on, we fail to reach the target over and over again. And remember what I told you in an early slide, we're going to use the clock itself as a risk management tool. So notice we start getting closer to end of day, which is going to be 2:30 Eastern time. And we're failing to reach 55.09 over and over again. We just fail over and over again where we can't reach it. So I'm going to start changing my target. Sorry. There it is. So into this resistance, I'm going to start changing my target, because the day's ending. And the other thing that I'm going to do is tighten my stop. So I'm going to change my stop to these swing lows. So my initial stop was 30. Remember, it was like 32 cents below. Once we start getting this resistance here and the failure to reach my target at 55.09, I take corrective measures and I change my stop to 54.45, this low here. And unfortunately, they do stop me out at 54.45. And this is a trade that just never reaches its target and just kind of peters out, and the clock is going to take you out one way or the other. So it's not such a terrible thing that we're going to get stopped out at 54.45, because as you can see, 54.40, and we're running out of time, not the end of the world. It's pretty close to what's fair value at the end of the trading day. So that's one example of how I day trade using a combination of pivots and average true range. Okay. Let's look at a summary of what happened. So 10:30, on the release of the inventory report, we ended up buying the breakout at 54.17. This was a technical breakout of the pivot resistance on the inventory news, and we placed our stop loss 2 times the average true range, 32 cents below entry at 53.85. By 10:55, we've got an unrealized gain of 32 cents, 2 times the average true range. So we can now cancel, replace our stop to a break-even stop. By 1247, we've got multiple failures to achieve the pivot resistance at 5509. At this point, we're going to cancel, replace our stop to the swing low that I pointed out to you at 5445. And at 1:42 p.m., we were stopped out at 5445 for a gain of 28 cents. So obviously, it's not the big profit we were looking for. Nevertheless, profitable trade. We allowed the market itself, along with the clock and the volatility of the market, to take us out for a small gain. Okay, let's look at another one. Oh, I'm sorry. Let's look at let's look at another one. So this time we're going to trade the January 24th inventory report. And this is going to be a case study where we're going to use the pivots just like before, but I'm going to introduce some other tools like time frame analysis, traditional simple technical analysis, the fundamentals, and the fundamentals including the clock as a risk management tool, just like we did in our first one. Okay, first things first, we're going to use time frame analysis to determine what kind of day is it. So we're going to start with the daily chart. And the question we're going to ask is simple stuff. Is it an inside day where we make no progress? We can't take out the prior day's high and we can't take out the prior day's low. If it is an inside day, we're going to look for consolidation. And a consolidation day, we're probably going to be more prone to looking for a breakout. Is it an outside day where we take out both the high and the low? In that case, we're going to want to know that outside day, did we end up in the middle of the range where we don't make any progress on a day-to-day basis? Then maybe we're going to look for consolidation and a breakout. Is it an outside day where we close lower than the prior day's low? Bearish day. Look for some bearish follow through, or vice versa, bullish day. And was the prior day a bullish day where we make progress to the upside? Was it a bearish day where we make progress to the downside? And based on what type of day the prior day is, it's going to set up a bias for us as to what we're going to expect today, our trading day. Then we're going to use simple technical tools like the moving average and ask simple questions like, was the prior day's close, was it above or below the 10-day simple moving average? Was it above or below the 5-day simple moving average? If it's above the 10, above the 5, bull day. If it's below the 10, below the 5, bearish day. Also, did the 5 cross above the 10? Are we dealing with a bullish crossover or a bearish crossover? And finally, where was the 9-day RSI in relationship to the 50 level? Why the 50 level? Because RSI is a percentage oscillator. It can never go above 100. It can never go below 0. So we're going to use 50 as an equilibrium point in order to determine what is the path of least resistance. So if we're above 50, we're going to look for a bullish day. If we're below 50, a bearish day, all things being equal. So these are the types of tools that we're going to use to help us in our analysis and to help us to day trade the market. Okay, a little more detail on RSI. So movements of near or above 70, overbought, near or below 30, oversold. And again, for me as a day trader, I'm looking at the 50 level as an equilibrium point. It gives me a mathematically objective answer to the question, do I expect a bullish day or a bearish day? And here's the math behind RSI. And you can see it's 100 minus 100 divided by the product of 1 plus RS, where RS is the average of, let's say, 14-day up closes divided by the average of 14-day down closes. Now you've got a mathematically objective answer to, do we expect the bulls to be in charge or the bears to be in charge vis-a-vis where we are on RSI vis-a-vis the 50 level. Okay, now that we've got that answer, let's move on and talk about what kind of day it is, intermediate term view. So we did our analysis on the daily market, daily chart, long-term view. Now we're going to drill down to the hourly chart. And simple stuff again, right? Just like I showed you before. Was the prior hour an inside hour? Was it an outside hour? Was it a bullish hour? Was it a bearish hour? Was the 10-hour simple moving average, did we close above it? Did we close below it? Have the 5-hour simple moving average? Did we have a crossover, bullish crossover, a bearish crossover on the 5, 10-hour moving average crossover? And how about the 9-hour RSI in relationship to the 50 level? Same tools, different time frame. So we developed a long-term view with the daily charts. Now we're developing an intermediate term view with the hourly charts. Okay, so now let's look. So remember, we start with the longer term view, the daily chart. So here you can see, what do we see on the daily chart? Not just in terms of the crossovers, right? So as you can see, we've got a bullish crossover. The 10-day is above the 5-day, so it's a bullish crossover. But it's a bullish crossover in terms of long-term bearish resistance. So we've got that long-term resistance at around $55 a barrel. And we've got short-term bullishness in that context of very long-term bearishness. Then RSI is above 60. Again, it's confirming that shorter-term bullishness in the context of very long-term bearishness. Next, let's drill down to our hourly chart. Now, interestingly enough, the hourly chart is showing us additional bearishness. RSI is below 50. And you can see here we've got some bearishness on this hourly chart, I would argue. Then let's drill down to the time frame that we're actually trading in, the 5-minute bar. So this is the view as of 8:30 a.m. Eastern time, prior to the open in the primary markets open in crude oil. So it includes all that overnight data. And you can see bullishness, RSI is above 50, and we've got a bullish crossover, and the close is above both the 10 and the 5. So you've got a mixed picture. You've got very long-term bearish view in the long-term daily chart, a short-term bullish view on the daily chart, an intermediate-term bearish view, and a very short-term bullish view on the 5-minute. Let's revisit the pivots, and you can see all 5 pivots here, and you can see we are oscillating between the main pivot and support level 1. There was a little bit of a move above the pivot to resistance level 1 in the overnights, but we came right back, and we are still oscillating between the main pivot and support level 1. Okay, what's next? All right, I wanted to give you a close-up view of the pivots. Now that I've shown you all 5 pivots, I wanted you to get a more granular view of the pivots, including the main pivot and support level 1, which we were showing you in the previous slide. So now you can really see it. Here you go. We're just oscillating between the main pivot and support level 1 prior to the release of an inventory report. Okay. Okay. Let's summarize. What kind of a day is it? So first question we're going to ask is, what could change the longer term trend over the coming trading day? And I think that answer was pretty obvious, that resistance level at $55 a barrel. So if we're going to go short, I think that's where our stop is going to be. What time is the news for our market going to be released in our trading day? And so we can look at oil specific. Do we have an inventory report that's coming out today? Is there an OPEC meeting? What about weather reports, private forecasts? Do we have the NOAA forecast coming out in the middle of heating season? Is this a factor? Is there a hurricane forecast that's going to be released? And then macroeconomic factors too. Do we have a news event coming out at 8:30 in the US, like the non-farm payrolls? Do we have a news event being released in China, like PMI? Also, is the FOMC going to be released today at 2 p.m. Eastern? What other fundamentals are going to impact potentially our trading day? And then we need to look at what happens prior and post the scheduled news release. So prior, do we have high volatility or do we have low volatility and the liquidity drying up? If prior we have low volatility and the liquidity drying up, remember that represents a high risk, low reward potential. So you want to stand aside and wait for the news event to be released and trade post news when the volatility and liquidity returns. Assessment. Is the news, when it's released, is it bullish or bearish within normal expectations? If it's within normal expectations, then we probably want to fade the trading action just beyond the support or resistance level. Or is the news release a shock to the market? In which case, just buy the damn thing or sell it. Follow the trend. So buy the bullish news, sell the bearish news. So you're going to have a gauge of what market expectations were coming into the report. And we at DTN have all sorts of tools to help you with that. What did all that tell us? So long term, the daily looks like we're below that key resistance level that I outlined to you before. So long term, I think daily looks bearish. All things being equal, I really want to be a seller into this trading day, especially with the report coming out. The hourly chart, low volatility, right? We couldn't really move much between the pivots, and we had a market in equilibrium overnight. And also, remember, we were pointing lower based upon the moving averages and the crossovers and the close, the most recent bar. Then the 5-minute bar is moving higher. So this is really a good setup for us as bears because it's what we call a time frame divergence. The longer term is bearish, the intermediate term is bearish, and the short term, our trading time frame, is actually bullish. So that's going to give us a good potential opportunity to short into some pivot resistance with a stop above the long-term resistance. What about the fundamentals? So due to the Martin Luther King Jr. holiday, which was on Monday the 21st, oil inventories are going to be released at 11 a.m. on Thursday the 24th, and we're trading this report. So as a review, these are the pivot levels. The main pivot is 52.64. We're probably going to use that as our initial take profit level. Resistance 1 is 53.43. Resistance 2 is 54.54. And then maybe we want to try and take profit into the pivot as well as into support. So our strategy is we're going to sell 50% of our volume, our ideal volume based upon our capitalization in our account at 53.43 at resistance pivot 1. Why? Because we don't want to miss a move. So resistance level 1, high probability of getting a partial fill. And then our dream price is going to be resistance level 2, 54.54. And then our stop is above the big resistance at 55.01. How are we going to get out of this thing? We're going to try and take profits into the pivot at 52.64. That's a high probability target. And then 50%, then 33% at 50.86, which is support level 2 for the pivots. Now also, if it hits 52.64, the pivot, we're going to cancel replace our stop to resistance level 1, 53.43, which remember is our entry price. So a break-even stop at that point. And then we'll exit the remainder at 2:30 Eastern. Why are we not exiting 67% at support level 2? Because what if the market really tanks after the news is released? We want to be able to participate at least with a little bit in case the market goes to like 44 bucks. So that's the strategy. And I'm hoping that makes sense, but we can always go back to it if you have questions at the end. Okay, so what happened? So what happened was, sure enough, we did sell 50% at 53.43. We immediately placed our buy stop at 55.01. We also got our exit we place our limit exit for 33% of the position at 52.64, and then for another 33% at 50.86. If it hits 52.64, remember we're going to cancel our stop loss and move it to a break-even stop at 53.43, and then we'll just exit the remainder. We'll have the clock take us out at 2:30 Eastern. All right, but as we get closer to 2:30, here's the update. We straight canceled our 54 sell limit because if we got filled, it's not such a great thing. It's too close to the close. And after our fill, we had a low print of 53.14. At this point, we're going to lower our stop to 53.38, okay, which is basically like a break-even stop, but we're trading a little below it, so that's where our stop is. And then we're going to raise our limit to buy back the entire position at the nice round number of $53. If we don't get $53, we're going to exit the whole thing, market on close. Okay? What's my reasoning here? We have this low at 53.14. The market is weak, right? Because they were trading below 53.38. So the path of least resistance is still down, and we're running out of time. So my feeling is they're going to take out those weak stops that are placed at 53.14. I don't know that they're going to give us 14 cents, but $53 a barrel is a logical, nice round number for the market to test, go maybe a penny or two below, fill us, and end the day. And here's what happens. So we got filled on our limit. We sold 50%, at 53.43. Because we were running out of time and the market was trading in like the 20s, we lowered our stop to 53.38, and we also raised our limit to close the short at $53 a barrel, or we get out market on close if they can't reach. So that's my strategy right here. Okay, then second update. It's, believe it or not, remember that limit at $53 a barrel? This is a real-time trade. At 2:27 Eastern time, right before the close, we do this bar. And this bar takes us down to 52.95, just like I anticipated. So we got filled and we sold our short at 53.43, and we were able to close out our short at 53 even, profit of 43 cents. So again, not our dream trade, but a nice solid win. Okay, so that was the presentation that I wanted to introduce. And I now wanted to open it up to questions. We can go back to the various slides and I'll answer some questions.
All right, guys, feel free to start typing your questions into the questions box and I will ask them to Richard. Those pivots are based on prior day's high, lows, and close, correct?
Yes, it is.
Okay. What is the initial balance? The imbalance from opening auction?
So the initial balance, so let's go back. So first questions first. So first questions first. So yeah, these are, here you can see the daily based upon the prior day, because of course you don't know today's pivots until yesterday is done. So it's always prior day. Next question was the market profile. So the initial balance is where the market begins its day. That's the initial balance.
Okay. What time frame were your charts?
So if you remember, we were looking at different time frames. I was executing off of a 5-minute bar. Okay. And the 5-minute bar is my primary tool for day trading. But we were also using the longer time frames like the hourly and the daily in order to determine what is the longer term direction, because we want to trade in the longer term direction, and potentially, ideally, we want to trade against the short term, the 5-minute direction.
Okay. Was your chart time frame in the pivots based off the RTH session or the ETH session?
It's based on the entire electronic because I trade everything. So in like currency markets, especially the entire 23-hour electronic day is very important, and I apply it universally on all assets, even in like markets like the grains.
Okay. Okay, you already answered that. What is the best way to determine daily directional bias from 9 a.m. to 2:30? Which direction will the day ultimately close?
So again, I use time frame analysis. So I think that you really want to look at these types of tools, starting with the daily. Was the prior day an inside day? Was it an outside day? Was it a bullish day? Was it a bearish day? So if you look at slide 17, The moving averages, did we close above or below the 10-day simple moving average, above or below the 5-day simple moving average? Did we have a bullish or a bearish crossover of the 5 and the 10? And how about the RSI? Were we above 50 or below 50? Those are all the types of tools.
Okay. Okay, I think you already answered this, but I'm going to go ahead and ask it as well. When doing your hourly analysis, are you using the hour before the pit opens or the last hour of the prior pit session?
So hourly analysis, we're looking at the whole 24-hour clock, and that way, when we look at the 10-5 crossover or the 14-period RSI, it's 14 hours. So it does include the low liquidity hours.
Okay. What is the difference between the Chicago pivots and the NYMEX pivots?
So, you know, I used to look at the NYMEX pivots. I used to have them all memorized, but honestly, my experience is that the Chicago pivots work better. So it's been over a decade since I even looked at the NYMEX pivots or the New York. Actually, they're not called the NYMEX pivots. They're called the New York pivots. So I only look at the Chicagos. And it could be kind of like self-fulfilling prophecy. Tom Baldwin was this huge day trader in the old CBOT interest rate pits, interest rate futures. And he was using the Chicago pivots, so now it's almost like universal that everyone uses the Chicago pivots. So I found a long time ago that they work better for day trading. So I could look it up, but I don't even look at it anymore.
Okay. How do you determine a statistical edge?
So you really want to have some kind of asymmetry between risk and reward. So if you remember what our targets were vis-a-vis the risks that we took, now, admittedly, we didn't reach our targets, but my targets, if we have a beautiful, like, you know, trend day and we catch the darn thing, my targets are multiples of my risk. So that's one element. And then the other element is a good high win rate, you know, win rate better than 50%. Now, day trading is tricky stuff because a lot of times, you remember what I said, you aim for the stars, but you land on the moon. And you see that in actuality, in both examples that I walked you through, that's exactly what happened. Because the problem with day trading, or maybe not the problem, the limitation with day trading is you're not going to hold overnight. So the closer you get to the end of the trading day, the more aggressive you are in getting out. So it's tricky. It's a trade-off. So you're not going to necessarily reach your profit targets all the time, but it should result in either smaller losses when you don't, because you're not going to get stopped out at the worst possible stop loss all the time either, and higher win ratios in general.
Can you go over what makes a day an inside or outside day?
Sure. So I'm gonna backtrack us a little bit. So okay. So this is an outside. See this green bar? This is an outside bar. So the high is above the prior bar's high. The low is below the prior bar's low. And this is an outside bar, and I would argue it's a bullish outside bar because we closed higher. We didn't actually close above the prior bar's high, but nevertheless, you can see this was the prior close. We had progress on the upside. So this is an outside bar with a bullish bias. But again, you want to keep in mind the longer term picture, right? Is that you're in a bearish mode and you're below the resistance. So yes, it's a bullish outside bar, right? But it's in the context of a longer term bear market. And that's why it's not so reliable. Look at what happens the next day, the next day, the next day. So you got to be careful looking at these things in a vacuum. You really want to look at them in terms of longer term trend as defined by the daily chart and its resistance and support and its path of least resistance. So that's an outside bar. I think it's pretty obvious now. An inside bar is the exact opposite. It's where you don't make any progress to the upside or the downside. So this green bar, this is an inside bar. This is the high, this is the low. Notice the high and low are within the trading range. And this is a bearish bar. See how we make progress, lower lows? That's a bearish bar. And this is a bullish bar. See, we make higher highs and we didn't make lower lows. It's close, but we didn't make lower lows. I could find you a better example. That's a good bullish bar. We make higher highs, we don't make lower lows, bullish bar. So that's the 4 types of bars.
Okay. Were all your examples based on one contract trades?
No, remember I said let's do 33% with this, 33% with this, 33% with this. So I had 3 levels. So potentially we were looking at a minimum of 3 contracts. Now, as it turns out, we only got filled on partials. But generally speaking, I will stagger entries and exits so that ideally I'm going to have multiple contracts at multiple levels, and I'm going to ideally exit at multiple levels.
Okay. Have you experimented with any momentum indicators to try to conclude if price action is going through a pivot or a bounce off of it?
I'm sorry, can you say that one again?
Have you experimented with any momentum indicators to try to conclude if price is going to go through a pivot or bounce off of it?
Mm-hmm. That was the word I was missing, was momentum. So I haven't per se. Instead I tend to look at other tools like inside bars, outside bars, bullish bars, bearish bars. I find that simple stuff tends to give me a good feel as to what it's going to do. Is it going to bounce or is it going to break through? Also, remember, I look at the fundamentals. I look at, are we in low volatility? Is a report about to be released? And you saw how, based upon that, I changed my view as to how to look at the pivots.
Okay. How does this work with market profile?
So I gave you 2 examples of market profile. Let me go back. So here you can see these are mechanical methodologies for market profile. Me personally, I don't use market profile for day trading, but I included it in the presentation just because a lot of traders do. It's commonly used by day traders, so I wanted at least to have I wanted at least a couple of slides on it in the presentation. But me personally, I focus on the tools that I outlined for you: the pivots, average true range, the time frame analysis, and the fundamentals, along with very simple technical analysis like support and resistance, and RSI and moving averages.
Okay. I lost the question. Where did it go? For money management, what market exposure risks do you take?
So I actually am pretty conservative. It depends on the models, but generally speaking, I'll risk 1% of assets under management on a particular trade. But if it's kind of a rare bird, like something that doesn't come up all the time, where I'm getting multiple opportunities in a given trading day, like these ones that I've been showing you, I'll bump it up to 2% of assets under management. So like I said, if you had 200, if you had 100 grand in an account, let's say, then you'd want to risk 2,000.
Okay. Do you use mechanical trading systems intraday? Did you try to build strategies based on these tools?
So, so yes, I have. Yeah, I have done that, and they are based on these tools. Yes.
Okay. All right, we are over time. I tried to answer all the questions I could. Thank you for the webinar, the information, and for spending some time with us this evening.
Thank you, Terry.
Thank you.
Richard, can I get you to switch it to your very last slide with the contact info? I'm going to leave the video on.
Absolutely.
So if you're watching this video later and you have a question, you can reach out to Dave or Richard.
All right. There we go. There's the contact information.
All right, perfect, guys. Thank you very much.
Thank you.